2022 is looking like a pivotal year for markets. Can the equity markets continue to run? How much room is there even to run up? Inflation continues to be a concern, with CPI ticking up to the highest level since 1982. Bill Baruch, president of Blue Line Futures, is here to discuss his macro outlook and the assets that he likes the most for this year. Bill, welcome back to the show. Happy New Year.
Happy New Year. Thanks for having me on again. It's always a pleasure to join you.
Always a pleasure. It's been a few months since you and I spoke. Not a lot has changed dramatically, although the inflation has run hotter, like I said in the beginning. Now, CPI, headline CPI came in this week at 7%. That's the highest reading since the 80s, 1982 to be exact. So inflation hedging is still obviously a concern for investors. How does it concern you? Does it concern you at all?
Well, I mean, I'm not concerned. You know, it's something that you want to adapt your game plan for. You know, you want to be more selective with tech stocks. It's something that I've been pounding the table on for the last few months. You want to, have commodity exposure too, as long as, where you're seeing right now, the Fed they're priced into hike rates about 3 times this year, but it's about almost 90% probability coming into the CPI number. It was about a 70% 90% they lift off in March, and a 70% they do a second hike in June. If you combine those two together, I mean, your commodities should not be derailed. They're not going to really disinflate the environment by hiking now, because the market's prepared for it. So I think if anything, we have some peak hawkishness, which could be, a near-term top in the U.S. dollar. Another few reasons why I'm looking at that too. But that I'm looking at as being a tailwind to commodities. And I think commodities within your portfolio help diversify right now.
You mentioned a 90% probability of liftoff by March. Have markets adequately priced that in yet, Bill?
I believe so. I mean, that's what we saw really early part of December, middle part of December, and then really mostly hitting us through last week. When rates were rising, you had the 10-year get to 1.8%. That was the environment pricing that in. And that not only so was the environment pricing in the other hikes too, or looking at high probabilities of those. So I think we're at a point where this is digested by the market.
Okay. And are you seeing any fear at all? Are you looking at something like the VIX, for example, and tracking what's going on there?
Really, what I'm looking at is from a positioning standpoint more than anything. I mean, look what happened with the Nasdaq and the broader markets through this Monday, and there was definitely some capitulation. It was indiscriminate selling. So what we did on Monday was put a note out to our clients, the video out to our clients, and say, listen, over the next 24 to 48 hours, we're going to understand whether this is indiscriminate selling and the market has much lower to go, or are we going to see a nice low come in that early Monday, and the markets are going to be able to consolidate from there higher it into Fed Chair Powell on Tuesday and the CPI on Wednesday. And that's what they did. So the markets are still playing to a narrative right now, that narrative being the path of the Fed tightening.
You mentioned earlier that you might want to ease up on tech stocks. I'm just curious as to why that would be.
Well, the high multiple names within tech right now. I mean, that's the high growth, high multiple stuff. And those are what's going to hit the hardest. I mean, as interest rates rise, I mean, those companies don't make money, they're borrowing money, and their balance sheets do not work in a higher interest rate environment. So where rates are very low, investors, they don't have a place to put their money, and they don't have a place to invest capital because you're not making any money in a savings account or a 10-year treasury. But now, as the 10-year gets back closer to 2%, where we see it today, and I think we may have a 2.15 ceiling, then investors have a choice now. They could get 2% rather than taking the risk of these high multiple names over, that are even as high as 60 to 100 and PE, those were getting hit pretty hard through Monday. So, I think it's just a different environment looking at value and cyclical stocks, commodity names. Look what Freeport-McMoRan has done. Look what Cleveland Cliffs has been able to do over the past couple of weeks. Mosaic as well. You're seeing commodity names that have done really well. And obviously underlying commodities have done very well. And then looking at value names. Obviously energy names, Chevron is completely broken out right now, Pioneer. But then you also want to look at the other value names with industrials and banks. And there's really, that's where you want to be. We're positioning in our portfolio. We're not throwing out all the tech, but we've really ramped up our overweight exposure in the value names.
All right, Bill. So are you saying that there's going to be a sector rotation in 2022?
Well, it's already occurred. That sector rotation has already started. We've seen a big move over the past week, sort of a vicious move, if you will. I think that continues. And so I don't think you're late to the party if you're just doing that now. But we use a number of models to manage risk, whether that's put structures below in order to hold on to some tech, whether that's the rotation itself, and we're doing a mix of the two.
And so, what sectors would you be overweight then this year?
Right now, we've been overweight energy, and we've been adding to energy even through December. Use the sell-off on the heels of Omicron after Thanksgiving as an opportunity to become overweight energy. That energy itself is about 2% weighting. Maybe up to almost 3% weighting in the S&P 500, and we hold that with about a 10% weighting right now, and half for a bit. Banks, they're about I think it's 11% weighting in the S&P 500. We're overweight with closer to 15 to 17% weighting. We do have some names that we sort of maybe a little quicker to the trigger with and take advantage of. But the banks have really, especially regionals, have really run pretty far. And I think you don't want to chase those into earnings, because the bank earnings do kick off Friday, and banks haven't really performed so well after earnings, but I think you'll find some buying opportunities after. Healthcare is a place we definitely are overweight and want to continue to be, with more than 20% weighting in the S&P, compared to our portfolios.
Okay. Oil, banks, they all sound like defensive. So are you saying that this year is still going to be the year for cyclicals? Are we still going to see risk on appetite?
Yeah, I think this year is going to be, it's a year where the cyclicals are going to outperform the high flying tech. And I think you want to stay nimble. Look back at last year. And last year we had the Pfizer news on early November. You saw a lot of the reopening stocks just surge higher through much of November, and then we started the year off 2021 with banks outperforming, energy outperforming. So you want to stay nimble in the sense that over the next few months, we're going to see the Fed's path a little more closely and have some answers. And what right now, as the new year's underway, it's definitely a stock pickers market. It's a sector pickers market, but that doesn't mean, like it was in 2021 last year, that once we get to the middle part of the year and we have those answers of the Fed and the Fed's path, we have some answers on growth, we have some answers that then allow those high flying tech names to outperform. So I think as we have that sort of playbook from last year right now, just at a higher place in interest rates than we were a year ago. But it's a very similar playbook, and that's why you want to stay nimble as we move, and get answers in through May and June.
And what about the recreation sector and the travel industry? Airline stocks, cruise ships, restaurants, hospitality sector. These things were doing well up until Omicron hit, and now we have people getting scared and being shut down and locked down. So yeah, how does this story play out this year, do you think?
There's some stocks really performing well, even despite Omicron. Expedia is a name that we own. We've owned it for quite a while now. And Expedia has moved really up to its high at the moment. MGM is another one that's performed pretty well relative to other casino stocks, gaming stocks. But I think that just goes to show that it's a stock pickers market. You can't just indiscriminately own a number of airlines and see and then face some headwinds. I do think though that there is a place for them in your portfolio. Like I said, we do own Expedia and MGM, but we are selective, and it's something that you want to continue to be.
Okay, let's move on to the precious metals now. Gold and silver, they don't do well during rising interest rates. Now, That's not to say that real interest rates will rise, but that depends on inflation, right? So first of all, how do you see real interest rates developing in 2022? And second, how will that impact gold and silver?
I'm really glad you brought this question up, because this is something that I've been hitting on recently for clients and talking about quite a bit. Is you right now you're seeing the German 10-year yield get back near 0%. It's basically hasn't been in positive territory since May. It was 2018, I think it is May 2018. Maybe it was maybe 2019, but we haven't seen it get back into 0%. What that means right now is, even though that the U.S. 10-year is trading at 1.8 and may even go to 2, and by the time the German 10-year is at 0, what it means is you're going to see currency flows, because if you were at a bank, and I have clients trading European products on European exchanges in our futures business, and they are charged a negative interest rate on that money that's held there for those exchanges. So I mean, we see it firsthand when that interest rate on the obviously the 2-year and the 5-year whatnot have a little room to go, but when that 10-year gets back there, I do think we're going to see currency flows from the U.S. dollar and into Europe. And listen, I mean, we're seeing the euro perform very well today, or first part of the week, and I think that could really continue if that gets there. I find that a tailwind. So normally when you see higher rates as a big headwind for gold, I find this a tailwind right now, just as long as just as long as those rates in Europe they stay on pace rising or outpace rising with those U.S. yields, because it's going to encourage a weaker U.S. dollar, and that's going to be a great tailwind and for gold. And in fact, that will help gold actually become an inflationary hedge.
That's a very interesting point. And just on that point about interest rates rising in Europe versus in the U.S., we do know that the currency pairs are driven partially, if not mostly, by interest rate differentials. Are you suggesting then that rates in Europe will rise even faster than in the U.S.?
They could. I mean, we've seen that through the middle part of this week. Now, one thing to remember too is Europe was battered by Omicron and Delta much worse. I feel much worse than what happened here in the U.S. Not necessarily on a case number basis, but just the economy's shutting down. And if we get through this Omicron, I also think there's going to be more of a reopening, if you will, in Europe compared to the U.S., meaning there's more room for growth in Europe. And that could be a great tailwind to rates in Europe relative to the U.S. And that, again, will encourage those flows. So I find gold at a very opportune space right now, because it can have tailwinds even within a rising interest rate environment. And that's something that I think is very nice as a reason to be invested in gold right now, but also the fact that very little people are invested in gold. If you look back historically, the managed money net long position via commitment of traders in the CME for gold is very low relative to where it's been historically, especially at these levels. And that tells me that if gold really starts to boogie higher, then we're going to see people chase gold higher, and that's what could get it out above 1900 and really off to run to new highs.
Okay, what is gold's role this year? Inflation hedge, stock market hedge, something else, all of the above? What does it do for you, Bill?
Yeah, I think it's going to be viewed as more of a stable asset, a little bit of an inflation hedge if we get that, if we do see the currency flows. It's also going to be a safe haven relative to just potential volatility in the equity markets. And I think that, you're going to people, listen, I'm very invested in the crypto space, but I do think you're going to start to see some flows from the crypto space, that were less sticky, if you will, less sticky flows that move to gold as more of a safe haven asset. And I think that's something where gold is going to serve, a number of roles this year. And I think that's one of the reasons why it can capitalize. Now, I'm also a realist. I watch these markets and trade these markets on a daily basis. I have levels that I know if gold gets down below, then I do not want to be long. So it really comes back to, this is a theory. This is what I expect in the market, but I'm still trading the markets. The markets are the boss, and I have to look at what they're telling me and not what I'm telling myself. So if gold does break below 1780, I mean, you got to be really looking to reduce positions in gold. If it breaks below 1750, I mean, you almost want to be short gold. So you got to be realist too.
Okay, let's talk about cryptos then, because you mentioned cryptos. Bitcoin, well, all cryptos really, but let's talk about the biggest one. Bitcoin, dramatic fall from its November highs, falling from over $60,000 a coin to, well, we're at $43,000 as we speak today, but it's touched 40,000. So it's been a tremendous decline. Now, this obviously has put tremendous downward pressure on the other cryptocurrencies. Is this the start of the crypto winter that some people have been talking about?
I really don't think so. I mean, I think it's just sort of we had a risk off across markets. The people that got burned in crypto, those that chased Bitcoin to 60,000 higher, and I think those weak hands have sold. And that's what a lot of this selling is. I did see a statistic that leverage has been rising in Bitcoin. So that's something that I do want to pay attention to right now, that may, if we are levered up here, say, sitting just merely shortly above 40,000, then same when I'm talking about managed money and gold, we need room for growth, for investment growth. So maybe that could keep a little bit of a lid on it, but I'm not necessarily looking at it from that angle. I'm looking at it, the fact that institutions are becoming more and more confident in Bitcoin and the crypto space. So that tells me that the money that's in there right now that did not sell out is very sticky. That sticky money is there to stay. They're looking for yield opportunities. Bitcoin may be, one that is the barometer of the space, but I think there's a lot going on with the space. I actually, not directly invest in Bitcoin personally right at the moment. I do have some clients on the future side that we got in earlier this week in that 41,000 area. And CME has a great contract. It's the micro Bitcoins, and it's a 1/10 the size of the Bitcoin. So it really gives us tremendous flexibility to size positions in Bitcoin the way we want and bring that to our clients. But for myself, I do believe that Bitcoin will go higher. That's why I've done it for my clients, and in the investment portfolios, we own Coinbase. But for myself, I also own things like Solana. I own Avalanche. I own Decentraland, which is ticker MANA, where you buy virtual land via NFTs. I mean, there's things like that are taking place right now, and there's also new projects that are launching. I'm invested in something called Metaverse Mining Alliance, which is a play to earn guild, so where they have assets within these games that they could provide players with. And, they also have a team of traders hedging treasury risk. These are very innovative ideas. And that's why I think the space is somewhere to definitely be, Bitcoin may be a barometer of the price.
Okay. Well, speaking of the barometer of the price then, well, it's $40,000 to $45,000. Is that range something that you're comfortable putting more money in right now?
Yeah, I definitely think so. I mean, I was adding to Solana, on this way down. I think, Solana as a blockchain is very fast, energy efficient, and it's going to grow. I think that we're going to see Solana close the gap between Ethereum in the coming 5 years.
Yes. Okay. Perfect. And on oil, let's finish on oil. You touched on energy earlier. You're bullish on energy still, right, Bill?
Absolutely. I mean, right now, crude oil is actually February contracts breaking out above its previous high. Your 82.85 is 82.15. It was the October high for February contract. We still have this front month highs, $85. But I'm very, very bullish on the space. I rattled off some names earlier on, like Chevron, Pioneer, and Marathon Petroleum. Those are what we own in our portfolios. They've run pretty good, but you're also seeing them actually break out above trendline resistances dating back to 2014, 2017. These are levels that tell me there's some really good tailwinds here. I mean, there's a lot of names in the space that can really have some serious upside, and a lot of these companies are really they're tethered. Right now being priced at a $60, $65 crude oil, and we have crude oil continue to rise here. We're above $80 today. Brent's at 84. So I mean, if we see crude oil continue to rise, and I think we'll be above 90. I think $100 can be tested, something that I've remained steadfast in. But if we see those, I mean, these companies have a lot of room to the upside, and their CapEx has been slashed. They've really gone out there and have done a terrific job on management. So I think that energy is a space that you need to be overweight in, and you need in your portfolio.
Well, Bill, are there any commodities or economic variables that have a close correlation with crude oil that you're also tracking on the side?
Well, I mean, consumer spending can be hurt with as the price of the cost of gas rises, and that's why you do see the White House out there right now trying to act offensive. Really, what they're doing is they're shooting themselves in the foot by releasing the SPR. The crude oil years ago would really trade on the excess supply that was out there, the spare capacity, and the fact that we're selling that off as at the same time it's been shown that only two OPEC countries, Saudi Arabia and UAE, can actually produce at levels in 2019. The US is not at 2019 levels. So I think those are consumer spending could take a little bit of a hit if we continue to see energy costs continue to rise. I'm wondering what that does to the European economy. I do think we get a nice reopening in Europe, but energy costs are rising, so it's something you want to pay attention to. I do remember back those days, and was it 2009, 2008, where crude oil was running well above $100, and days that it was up very much, rally from 105 to $110. These were very volatile moves, but it would hurt the stock market. It would hurt certain sectors within the stock market. So that's something you want to pay attention to if we do get out above $100.
Okay, excellent. Bill, thank you so much for your insights. I appreciate your outlook for 2022, and we'll speak to you again soon. Thank you.
Thank you very much for having me.
Well, thank you, Bill, and thank you for watching Kitco News. I'm David Lin. Don't forget to subscribe to our YouTube channel for more news and updates, and to follow the remainder of our Outlook 2022 coverage.